The U.S. Federal Reserve has raised its benchmark interest rates by half a percentage point. That's the biggest increase in more than 2 decades, as the American Central Bank tries to tame historic consumer price hikes in the world's largest economy. Rates set by the Fed directly influence the amount that banks charge for loans. So, the higher they are, the less likely consumers will use their credit cards or take out mortgages. It also makes it more expensive for businesses to borrow money to expand their operations. But that's not all. The Fed says it's also shrinking its balance sheet starting next month. It's selling government debt and mortgage-backed securities that it bought up during the pandemic. That would effectively suck out hundreds of billions of dollars from the financial system. The Fed's doing all of this in the face of an unprecedented combination of inflationary pressures.
We have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. We need to somehow find price stability out of this, and it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with.
Now, for more, let's go to David Madden. He's a market analyst at Equiti Capital in London. Welcome back to the program, David. Now, could you walk us through the market reaction to this announcement? Because U.S. stocks rallied significantly yesterday. Why are investors so optimistic?
I wouldn't get too ahead of ourselves here and say they're overly optimistic. The upward move we saw in U.S. stocks yesterday needs to be put in the context of the major losses we've seen in U.S. stock markets recently, partially due to the war in Ukraine, but also partially due to the fears what the Federal Reserve might have announced last night. Now, last night, as you mentioned in your intro, the Federal Reserve, the U.S. Central Bank, hiked interest rates by 50 basis points, half of 1%. But that was very much signaled for quite some time from the U.S. Central Bank. So it wasn't exactly a surprise that they hiked by that amount. What was, though, it was caught some traders off guard, though, was that the language and the commentary and the kind of outlook that the Federal Reserve used wasn't as hawkish as you say in the markets, or they didn't really give off the impression that they're going to be aggressively hiking interest rates time and time again in the next few months. Although they did state, we are going to see further rate hikes down the line. It gave off the impression we're not going to see maybe as many interest rate hikes or as large interest rate hikes as markets had feared. So we had a classic example of markets essentially becoming too fearful in the preceding weeks to the announcement. Markets in the S&P 500, the well-known US benchmark, fell to its lowest level in almost 1 year, only at the beginning of this week. So the gains we're seeing today is almost like a bit of a relief rally, in that people saw the announcement from the Fed and thought, oh, the Federal Reserve, although the hiked rates by 50 basis points, we're probably not going to see another 50 basis points hike in the near term, or even potentially for, let's say, 6 months. And with that, they've now kind of decided to kind of step in and buy up some relatively cheap stocks.
Right, David, as you say there are more rate hikes ahead, although the timing is still uncertain. But could you tell us the effect that higher rates will have on the U.S. economy, particularly in the housing market, which is very sensitive to higher interest rates, and of course, consumer spending and the expansion of businesses in the U.S.?
Well, all of those sectors are likely to be negatively impacted by an increase in the cost of borrowing. As you mentioned, the housing market, it is very sensitive to what goes on in relation to interest rates and, in turn, mortgages. We've had in many U.S. cities, likes of New York and the likes of San Francisco, for example, have had kind of red-hot property booms in terms of the cost of prices has been extremely high. This is partially be funded by very cheap or very, very low interest rates and in turn very low mortgage rates. As costs and monthly payments start to go up, that's going to again eat away at what people can actually afford, and therefore ever so slightly chip away at demand. This is part of the reason why the Federal Reserve probably don't want to kind of have too many large rate hikes in quick succession. Because if you increase the cost of borrowing on a large quantity per time very quickly, all of a sudden that's going to impact people in terms of higher mortgage payments, higher credit card payments, business loans. Businesses will find it more costly to borrow money to invest and expand their business. in relation to individual consumers. If people realize that it's going to cost them more and more money to borrow money, i.e. put things on their credit card, they're going to be less likely to do it. Once again, chipping away at demand, be it the housing market or be it retail items or indeed business expansion. So as we move forward throughout the year and rates do continue to rise in the US, that's essentially going to act as a cap on demand.
All right, we will have to leave it there. David Madden from Equiti Capital in London, thank you for joining the program.
Thank you.